Companies charge the actual cost of direct materials and direct labor to specific jobs. Manufacturing overhead relates to production operations as a whole. As a result, overhead cost cannot be assigned to specific jobs on the basis of actual costs incurred. Instead, companies assign manufacturing overhead to work in process and to specific jobs on an estimated basis through the use of a predetermined overhead rate. The predetermined overhead rate is based on the relationship between estimated annual overhead cost and an expected annual operating activity, expressed in terms of a common activity base. The company may state the activity in terms of direct labor cost, direct labor hours, machine hours, or any other measure that will provide an equitable basis for applying overhead costs to jobs. Companies establish the predetermined overhead rate at the beginning of the year. Small companies often use a single company-wide predetermined overhead rate, whereas large companies often use rates that vary from department to department. The formula for a predetermined overhead rate is estimated annual overhead cost divided by an estimated annual operating activity, such as direct labor hours or machine hours. Overhead relates to production operations as a whole. To know what the whole is, we would need to wait until the end of the year's operation. At that time, the company knows all of its costs for the period. Managers cannot wait until the end of the year. To price products effectively, managers need information about product cost during the year. Using a predetermined overhead rate enables a cost to be determined for the job immediately. Companies use the predetermined overhead rate to assign overhead to work-in-process inventory as well as to specific jobs. You simply multiply the predetermined overhead rate by the actual activity base used, such as actual direct labor cost or actual direct labor or machine hours. Wallace Company uses direct labor cost as the activity base. Assuming that the company expects annual overhead cost to be $280,000 and direct labor cost for the year to be $350,000, the overhead rate is 80%, which is calculated as the estimated annual overhead cost of $280,000 divided by the estimated direct labor cost of $350,000, or 0.8 or 80%. This means that for every dollar of direct labor, Wallace will assign 80 cents of manufacturing overhead to a job. The use of the predetermined overhead rate enables the company to determine the approximate total cost of each job when it completes those jobs. Wallace Company applies manufacturing overhead to work in process when it assigns direct labor costs. It also applies manufacturing overhead to specific jobs at the same time. For January, Wallace incurred $28,000 in direct labor cost, so it applied $22,400 of overhead, which is calculated by taking the direct labor cost of $28,000 and multiplying it by our predetermined overhead rate of 0.8 or 80%. The following journal entry assigns manufacturing overhead to the work-in-process inventory. You simply debit work-in-process inventory for $22,400 and credit manufacturing overhead for the same amount. This journal entry reduces the balance in manufacturing overhead and increases the work-in-process inventory by $22,400. The overhead that Wallace applies to each job will be 80% of the direct labor cost. It will post manufacturing overhead to each job at the same time direct labor is posted using the predetermined overhead rate of 80% of direct labor cost. In this example, if direct labor costs are $9,000, we would simply multiply it by 80% to obtain manufacturing overhead of $7,200. This image shows the work-in-process inventory account and the job cost sheets after posting. Note, the debit of $22,400 to the work-in-process inventory equals the sum of the overhead applied to job number 101, 102, and 103. At the end of each month, the balance in the work-in-process inventory should equal the sum of the costs shown on the job cost sheets of unfinished jobs. The amount in the control equals the amount in the subsidiary accounts. It also assumes that all jobs are still in process. Companies typically classify manufacturing cost into three broad categories: direct materials, direct labor, and manufacturing overhead. Companies charge the actual cost of direct materials and direct labor to specific jobs. In contrast, manufacturing overhead relates to production operation as a whole. As a result, overhead costs cannot be assigned to specific jobs on the basis of actual cost incurred. Instead, companies assign manufacturing overhead to work in process and to specific jobs based on an estimate. It's relatively easy to trace direct materials and direct labor to production jobs. Manufacturing overhead bears no obvious relationship to jobs or units of product. Manufacturing overhead is a pool of indirect materials, labor, and other costs. These costs must be incurred for production to incur. We must essentially estimate overhead costs to jobs or production in order to have a complete picture of product costs. The solution to this journal entry will be provided in the next video.